Imagine you close on a beautiful home this summer, expecting your property taxes to be somewhere around $1,000 a month. I mean, everything's going great until the end of the year rolls around and you find you have a massive escrow shortage. Because not only do you owe the tax from the time you owned the home, but you also owe them from the time before you even owned the house. You owe for the whole year, even though you've only owned it since June. Now, right about now, you might be thinking, you know, Wendy, I thought you were smarter than that. Property taxes are prorated at closing. You know, the seller pays his share and I only owe taxes from when I bought the home. Well, believe it or not, this is a huge tax trap you can get caught in. You can literally get a bill and be told you have to pay for the whole year. You'll find this happening, okay, this very thing, if you buy a home from someone who is exempt from owing property taxes. At closing, when it's time to prorate those taxes, the tax certificate is going to say exempt. And it's not that it's wrong. All right, there are numerous times when a property owner is completely exempt from paying property taxes. The Texas Comptroller explains this. It says, a surviving spouse of a member of the U.S. Armed Services killed or fatally injured in the line of duty is allowed a total property tax exemption on his or her residence homestead if the surviving spouse has not remarried since the death of the armed service member. So that's just one example, okay? Another one is for disabled veterans. It explains a disabled veteran awarded 100% disability compensation due to a service-connected disability and a rating of 100% disabled is entitled to an exemption from taxation of the total appraised value of the veteran's residence homestead. So you go to closing, the taxes should be prorated, but they're not because the owner qualifies for a full exemption. He doesn't owe taxes at all, so there's no prorated share that he's going to pay. But guess what? The minute he sells that house, the exemption is gone. Now taxes are due just like they always would be. The house was exempt for half of the year, but now that you own it, it's no longer exempt. Well, guess who doesn't understand that distinction? All right, it's the automated billing system that sends the property tax statements at the end of the year. It reads what the current ownership and exemption status is and sends the bill. The system, it doesn't research a title or exemption history when it sends out bills at the end of the year. All it knows is that as of the time the bill is due, the house has no exemptions. So it's going to bill you for the entire amount. Now, there are other partial exemptions that fall off at the end of the year when a home changes ownership. I mean, for example, this is why a new owner has to file for their homestead exemption, right? The previous one falls off when the house changes hands. But what makes this total exemption so onerous is that it drops off immediately in the middle of the year. We had this happen on a recent transaction. Our client had watched a video where the YouTuber said that if a sale like this happened, the new owner would owe for the whole year and that they needed to be aware of that. Well, I was like, that does not make sense. All right, if the taxes are exempt, they're exempt. So I started asking everyone I knew at title companies, and the first one I reached out to, okay, they said, yeah, that's correct, because the system doesn't know the difference. Well, that still just did not sound right to me, okay? So I did a little digging again on the Comptroller's website, and on their FAQs, I found a really relevant question. It says, if a 100% disabled veteran moves to a different residence homestead in the middle of a tax year, what happens to the exemption on the previous property? Okay, and then it answers, if an exemption applied to a residence homestead on January 1 ends during the year, taxes due on the homestead for the portion of the year after the date the exemption ends. From there, a little digging with Rockwall CAD revealed the same thing. The appraisal district is going to charge you for the entire year. The onus is on you to go to them and prove no taxes were due prior to you owning the home because it was exempt. This one is absolutely going to fall on you to communicate very proactively with the appraisal district. Save your closing documents. a copy of the tax certificate, and just know that this will absolutely come up. Now listen, this is what you want to not do. If your loan is escrowed, okay, and chances are it probably will be, that means your lender handles paying the property taxes. Well, guess what? It's not like they're gonna do the research either. If you are passive about this, you're gonna receive notice of a huge escrow shortage after they've paid your tax bill. Your mortgage payment is going to go way up, and now not only do you have to deal with the appraisal district, but you have to get everything sorted out with your mortgage company too. Now your mortgage payment has gone way up, and if you don't pay it on time, it's going to hit your credit as a late mortgage payment. So now your credit score is affected. Oh, and since the mortgage company's already paid the property taxes that you never owed in the first place, you have to work it out with them as well. It might look something like this, right? The appraisal district pays the mortgage company back and you finally get your house payment back to normal. How long might this process take? I mean, who knows? Maybe months? So what you want is you want to be super proactive. Get comfortable with the Central Appraisal District now. Check out the exemptions on the home long before you go under contract. Be aware of what you're getting into. Then, once you own the home, talk to the Central Appraisal District before the tax bills are even issued, or as soon as possible thereafter. If you don't dispute this, they assume you owe it, and your mortgage company assumes you owe it too. I mean, do you see how this is such a massive trap even when everyone did things right? It's gonna take you being informed and you being proactive to not get caught up in this. Now, in this situation, you can see it's gonna be about a pre-owned home, right? You're not gonna see those exemptions applying to home builders. But unfortunately, there are tax traps that go with owning new construction as well. And one of those happens when you're buying new construction and the lender qualifies you on a house you can't afford by setting up the escrow account wrong. And you might be thinking, wait, hang on a second, it's their job to get that right. And you're correct. But regardless, the process by which some lenders are qualifying their borrowers is a giant trap. And here's how it happens. Let's just say a new construction home is valued at its land value of $40,000. The property taxes might be $50 a month. Well, the very next year, the home will be reassessed and the value will go from $40,000 to $500,000. And there's probably a difference of $500 a month there in property taxes. And guess what? The lenders are qualifying their borrowers based on the $50 per month instead of the actual number the property taxes will turn out being. So we're talking within 1 year, all of these borrowers' payments are going to go up by like $500 a month or probably more. I mean, think that's going to put some of them in default? Yeah, it absolutely will. Your average homeowner can't handle their mortgage payment going up by $500 a month. Loan officers should be qualifying their buyers based on what their taxes will become, not what they are at land value. Buyers in this situation are genuinely not qualified for the homes they're buying, yet they're being told by professionals that they are. I mean, think about the implications here. Homeowners are starting out with a massive escrow shortage that they have to pay back, plus their mortgage payment will be much higher than what they were actually qualified for. Picture yourself as a new homeowner coming face to face with all of that. I mean, first you have to pay back your escrow shortage. Then in addition to that, you have to pay what the new monthly amount is. Your payment could go up by literally $500 a month. Now, I want to show you what this looks like on a settlement statement at closing so you know what to look for. Now, keep in mind that a typical $350,000 home with the homestead exemption will cost you around $600 per month in taxes. Now, most of our buyers are well above the $350,000 range, so that really is like a bare minimum of what you should expect. Now, I'm going to show you some actual real settlement statements. On our first example, you can see under initial escrow payment at closing, the amount set up for the monthly property taxes is $142 a month. I mean, even if this buyer bought a $350,000 home and he's looking at property taxes of $600 a month, that means his payment is going to go up by over $450 every month. In the second example, if you look at the impound section, you'll see they qualified this buyer based on them paying $180 per month towards their property taxes. Within a year, their payment is going to go up by more than $400 a month. Now, I want to show you this next example where the escrow account is set up correctly. Here you can see the property tax escrow is set up at $739 a month, and that's the way it should be. This is how a settlement statement should look. And now that you know what to look for, okay, don't be one of those homeowners who are crushed under the weight of their new property tax bill. Now let's talk about yet another trap. Let's talk about how builders deal with property taxes. Property taxes in a home sale are going to be prorated up to the date of the sale. That's true whether it's pre-owned or new construction. And what we mean by that is the seller pays for the property taxes up until the day the property is sold. Then the buyer takes on the property taxes from that point on. Okay, this is pretty straightforward when you're buying a pre-owned home, because that home's value isn't going to change astronomically from one year to the next. But it becomes really sticky with new construction, and every builder deals with it differently. The value of a 60 by 120 patch of dirt is generally gonna be worth somewhere around like 40 or 50,000 to the tax appraiser. It's unimproved, okay, pretty much meaning, it's just dirt. But then the beautiful new construction home, takes place, and you have this absolutely stunning new home. In other words, okay, now you have what's known as property plus improvement. In the eyes of the property tax assessors, the value has gone from 50,000 to, let's just say, 1 million. Over the course of 1 year. When closing day arrives, the title company is going to obtain a tax certificate and the property taxes are going to be prorated. But here's your problem. Many times the new value isn't reflected at closing, but it will be reflected by the time tax bills come due at the end of the year. So let's just say you're buying in Collin County in the city of Prosper. You're in Prosper ISD in the Collin County Water District in Collin College, and the appraisal district has your home listed at the land value of $50,000. Now the taxes at closing will be $1,593.28 for the entire year. This will be prorated between the builder as the seller and you as the buyer. If you close in March, for example, the builder will pay 3 months worth of that amount, so roughly $400. But now you've been in your home for most of the year. It's beautiful, you love it. But then October rolls around and the tax bill arrives. The appraisal district has reassessed your home correctly as land plus improvement, and now it's valued at $1 million. Your new tax bill is $31,865.63. Now you owe that $31,865, of which the seller paid what, $400? He should have paid close to $8,000 for owning the home for the first 3 months, but no, he paid just $400. Now, here's what you need to know. Every builder knows this happens, and they all have different ways of dealing with it. If you're buying from Antares Homes, they say taxes shall be prorated to the closing date. If the taxing authorities are unable to quote the amount of actual property taxes for the current year, the proration of taxes shall be based on actual taxes on the property for the prior year. The proration of taxes shall be final and not subject to adjustment due to a subsequent change in actual taxes owed or otherwise. Now, if you're buying from Centex Homes, you're gonna find something similar. They say all real estate taxes will be prorated as of the closing date. The proration of real estate taxes and assessments will be based on the most recent tax bill issued prior to closing. All prorations will be final and not subject to adjustment after closing. Okay, so that's Antares and Centex. Let's see what Bloomfield has to say. If you're buying from Bloomfield, their contract reads, all taxes for the current year based upon the preceding year's taxes, if the taxes for the current year have not been set, shall be prorated as of the date of closing of this contract. But then you have Normandy Homes, and they do us a solid on how they deal with property taxes. Their contract reads, if the amount credited at closing is based upon an estimate and the actual tax bill received after closing varies from the estimate and that purchaser is owed more than the credit received, purchaser shall have until March 31 of the year immediately following the year of closing to send written notice to seller seeking reimbursement for the difference between what was paid by seller and what was actually owed by seller. MI does actually do us a solid on the property taxes too. Here's what their contract says. Purchaser shall be responsible for purchaser's share of taxes for the property attributable to the number of days during the year that purchaser owns the property. But if the tax bill is not yet available at the time of closing, then the proration shall be based on the prior year's tax bill or MI's estimate of the taxes or assessments. Okay, so we've heard that song and dance before, right? But here's where it gets good. If the taxes or assessments are estimated, either party may request a re-proration based on the actual tax figures before March 31st of the year following closing. So you have some builders saying, hey, we understand how the system works, let's make sure it's right. But others saying proration at closing is absolutely final. And here's what you need to know. Builders know exactly what they're doing with this whole proration thing. And if that surprises you that they do it anyway, you need to know that's just the tip of the iceberg. I mean, you can learn a whole lot more watching this video here. In the meantime, Wendy out.